Hey there, today I want to talk to you about the thing that you have to know if you want to use moving averages as part of your trading system. Now I've got a couple of middle of the range midterm moving averages here. This is a 21 exponential moving average and I've got a 55 exponential moving averages. Now these are midterm moving averages. So they're not a 200, but they're not an 8. They're in the middle of the road. They are kind of a midterm set of moving averages. And when you're trading, you would like to have at least one of these midterm type moving averages on your chart. And I'll explain exactly why that is and why this is really important. So the 21 is the one I want to focus on. When I have the 21 above the 55, I have a really good idea of what direction the trend is, which is why the 55 is here. So I'm not going to get chopped out of too many trades. If I have the 21 below the 55, again, I know that the trend is down. That is the ideal direction. The market is most likely going to make the biggest moves in that trending direction. So when I'm paying attention to the market, what I want to see is how the price interacts around that 21 EMA. The market is going to move away from that 21 and then get back into it. That is a law. That is going to happen on whatever time frame you're looking at. The price can get away from the moving average, but it won't stay away. It'll come back again. And those give us the best opportunities to trade. So I'm zoomed out a little bit just so you can see an overview of this. But let's look at the daily time frame. That was the 4 hour. So in the daily time frame, price gets away, comes back in, gets away, comes back in. It's in here, it's in here, it's in here. Price always returns to that 21 EMA. No matter what direction the trend is going, in an uptrend, market will move away and then come back in, and then move away and then come back in. Let's take a look at this on the 1 hour time frame. Exactly the same thing on the 1 hour time frame. Price gets away and comes back in. And you can see how this is a consistent feature of this midterm moving average. I like the 21 because the price comes into it a lot. It is going to get away and come back to it a lot. The 55, it is going to do that with the 55, but it's not going to be as frequent as it is with the 21. And then when you're looking at something like a 200, it will come back to the 200, but it will take its time to do that. With the 21 EMA, the market will get away and then come back in, get away and then come back in. So let's take a look at why this is important. Now, first of all, you want to be looking for your trading opportunities when the price gets close to that 21 EMA. Now I'm going to use my pen. I'm going to mark up the charts just a little bit. But when the price gets close to that 21 EMA, we can see that we have a really nice move to the upside. We've got that bounce because we have that trend is up. And again, we get that area here where the price gets to that 21 EMA and the market moves up. Price gets to the 21 EMA and the market moves up. Price gets to the 21 EMA and it starts to move up. Of course, it's like anything else in trading. Most of the time, something is going to work. Sometimes it's not, but that is where the probability is. We are looking for the price to get into those moving averages and they give us the best trading opportunities. Now, on the other side of that is when the price starts getting far away from that EMA, we have a really good idea that the potential for the price to continue moving up just isn't there anymore. We need to see a pullback into or close to that 21 EMA. So once the price has started moving away from that EMA and we have a distance between the market and that EMA, we no longer can expect the price to continue to move. Every once in a while it's going to, but that every once in a while is not something that happens enough that I'm willing to bet money on it. And we can see again here, price gets away from that EMA and eventually it has to come back. So if you are counter trend trading and you like to trade against the trend, these are going to be smaller trades, but you can time them a little bit better when you see how far away the price gets from those EMAs. Once there's a big gap between the price and the EMAs, there is more likely going to be a chance that we'll see a market that moves in towards those EMAs. But for me, I'm a trend following trader and I like to take advantages of those opportunities when the price gets to or gets very close to that 21 EMA. Now, you may have a way of entering the trades that you like. What you're going to find is that when the price gets close to the 20 EMA, a lot of the times we're going to get bigger candles that push away from those EMAs. And in this case, an entry could be here as we get a candle that moves higher than the previous high of the pullback candle. And the same thing with something here, and the same thing with something here, and the same thing with something in here. We have opportunities as the price is moving away from those EMAs. The price is going to move further away from the EMAs than they are going to move into the EMAs. So the best trades are the trades that go away from the EMA once the price gets to that EMA. So we can look at this on any time frame. This is a daily time frame. This is a weekly time frame. And we can see how this works just over and over and over again. We get the price coming back into those EMAs, that 20 EMA. We could just see how the price is bouncing, 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 bouncing. It moves away and then comes back. Now you have to understand this concept if you want to be profitable trading. You have to know that this is how the market works. And if we're using something like the 21 EMA, you've got a really consistent method of doing this. Now, it doesn't have to be an exponential moving average. You can use a simple moving average. That will do the trick as well. So if I zoom out on this, even with that simple moving average, price is going to come back into that 20 simple moving average. Now, again, I prefer the exponential moving average, but if you have a preference, whether it's the EMA, the SMA, it doesn't even have to be the 21. It could be something else. It could be like a 34. So let's change this to a 34. We'll go exponential and we'll see how that works. The price still needs to get into it. Now, the bigger this moving average is, the bigger this number, the setting. So if you're going from 34 to 55 to 89 and so on, 144, you're going to start seeing that the return to that EMA or that moving average happens less and less. So we'll be looking at, let's get rid of this one. We'll be looking at a 55, and you can see that the price does return to the 55, but it's not as regularly as it returns to the 21. Now, we do get a lot of times where it does return, but it happens over a lengthier period of time. And if I change this to 100, for example, we can see that the price does get back to the moving average, but again, it takes longer to do it. And when we do get those retracements to that moving average, the bigger the period, the more likely that it's not going to make it all the way to that moving average, which is why I prefer the 21 EMA for this. You can even go a little bit shorter. You can do something like a 13 EMA, and you'll see that the price bounces off it much more regularly because you're hugging the price a little bit more. But one of the nicest settings for this is, I feel, the 21 EMA. Now that you understand how this works, how the price moves around the 21 EMA, you're going to be able to make much more educated, much better trading decisions. Now, when I have something like this, I like to add a second moving average on here because you're looking at a situation like this, you're looking at a situation down here, you're looking at a situation up here where you may get a wrong idea of the trend, which is why I like to add a second moving average. Generally, if I'm going to use a 21, I'm also going to put on the 55, and with the 55, I get a much cleaner idea of the overall trend. So in this case, the price can move against that 21 EMA quite a bit and eventually end up going back in that right direction. Again, the price moves on the opposite side of that 21 quite a bit, but ultimately it moves back in that trending direction because we have that 21 underneath the 55. So I'd like you to give this a try. See what you think with this. Now, again, it doesn't have to be the 21. It can be something similar, but that sort of midterm moving average tends to work the best. Do some experiments, do some testing, and then whatever your entry criteria is, make sure that if you're trend following, that you're taking those entries closer to that 21 EMA before it takes off. If you have an entry criteria and it happens when the price has moved away and it is away from that 21 EMA, you're going to be looking at really hard fought, rarely won trades. If you're looking at going short in an area like this, it is going to be a struggle to win. You're going to lose more often than you win. But if you're taking a trade in an area like this, or an area like this, or an area like this, where the price hasn't moved away from that 21 EMA, you are more likely going to get an opportunity to have the market move in your favor and really far. You're going to have smaller stop losses and you can have much bigger targets. So using these EMAs properly really is going to help your trading. You can build an entire trading system just on 2 EMAs like this. All right, best of luck to you, and I'll see you in another video.